Let's get you ready for one of the most heavily tested sections on the SAFE MLO exam, loan types and products. In this video, we'll cover the key differences between conventional, FHA, VA, and USDA loans, explore common product structures, and break down what suitability and risk mean for borrowers. And don't miss what's happening in the bottom corner. There's something there that can give your prep a serious edge. Let's get started.
Overview of loan categories. Definition and purpose of mortgage loan types. Emily is considering a mortgage loan that allows her to pay only the interest for the first few years before starting to pay down the principal. What type of mortgage is she considering? Is it A, fixed rate mortgage, B, adjustable rate mortgage, C, balloon mortgage, or D, interest-only mortgage? The answer is D, interest-only mortgage. An interest-only mortgage allows borrowers to pay only the interest for a set period, deferring principal payments to a later date. What is the primary purpose of a reverse mortgage? Is it A, to purchase a new home, B, to convert home equity into cash, C, to refinance an existing mortgage, or D, to reduce monthly mortgage payments? The answer is B, to convert home equity into cash. A reverse mortgage allows homeowners, typically seniors, to convert part of their home equity into cash without selling their home.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to Birdsy AI for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Ages non-agency loans. John is considering a mortgage and wants to know which type of loan is backed by government-sponsored enterprises. Which loan should he choose? Is it A, agency loan, B, non-agency loan, C, jumbo loan, or D, Federal Housing Administration FHA loan? The answer is A, loan. Agency loans are backed by government-sponsored enterprises like Fannie Mae and Freddie Mac, providing more security for lenders. Which of the following best describes a non-agency loan? Is it A, a loan backed by Fannie Mae, B, a loan not backed by government-sponsored entities, C, a loan with fixed interest rates, or D, a loan insured by the government? The answer is B, a loan not backed by government-sponsored entities. Non-agency loans are not backed by government-sponsored entities, often resulting in higher interest rates and more stringent qualification requirements. Conforming versus non-conforming loans. A borrower is considering a loan that meets the underwriting guidelines set by Fannie Mae and Freddie Mac. What type of loan is this? Is it A, non-conforming loan, B, conforming loan, C, subprime loan, or D, jumbo loan? The answer is B, conforming loan. Conforming loans meet the guidelines set by Fannie Mae and Freddie Mac, making them eligible for purchase by these entities. Which of the following is a characteristic of a non-conforming loan? Is it A, meets Fannie Mae guidelines, B, eligible for Freddie Mac purchase, C, exceeds conforming loan limits, or D, strict underwriting standards? The answer is C, exceeds conforming loan limits. Non-conforming loans do not meet the standards set by Fannie Mae and Freddie Mac, often due to size or borrower credit profile.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Conventional loans. Eligibility requirements for conventional loans. John is applying for a conventional loan and has a credit score of 720. What is the minimum credit score typically required to qualify for a conventional loan? Is it A, 580, B, 620, C, 700, or D, 50? The answer is B, 620. Conventional loans usually require a minimum credit score of 620. John's credit score of 720 exceeds this requirement, making him eligible based on credit score. Which of the following is a key eligibility requirement for obtaining a conventional loan? Is it A, stable income, B, no debt, C, marital status, or D, property location? The answer is A, stable income. A stable income is a key requirement as it assures lenders of the borrower's ability to repay the loan. Loan limits and Fannie Mae Freddie Mac guidelines. John is applying for a conventional loan to purchase a single-family home. The loan amount he needs is $600,000. According to Fannie Mae and Freddie Mac guidelines, what is the maximum conforming loan limit he must consider? Is it A, $548,250, B, $726,200, C, $647,200, or D, $800,000? The answer is B, $726,200. For 2023, the maximum conforming loan limit for a single-family home is $726,200. John's $600,000 loan amount is within this limit. What is the primary purpose of Fannie Mae and Freddie Mac's conforming loan limits? Is it A, to increase interest rates on mortgages, B, to restrict home ownership, C, to maintain liquidity in the mortgage market, or D, to regulate real estate prices? The answer is C, to maintain liquidity in the mortgage market. Conforming loan limits help maintain liquidity in the mortgage market by standardizing the maximum loan amounts that Fannie Mae and Freddie Mac will purchase. Private mortgage insurance. John is buying a home with a conventional loan and a down payment of 15%. Which of the following is true regarding private mortgage insurance in this scenario? Is it A, John is not required to pay PMI, B, John will need to pay PMI until he reaches 20% equity, C, John can avoid PMI by choosing a fixed-rate loan, or D, John can remove PMI by refinancing his loan? The answer is B, John will need to pay PMI until he reaches 20% equity. PMI is typically required on conventional loans when the down payment is less than 20% to protect the lender from default risk. What is the primary purpose of private mortgage insurance on conventional loans? Is it A, to protect the lender in case of borrower default, B, to reduce the interest rate for the borrower, C, to increase the borrower's credit score, or D, to decrease the home's property taxes? The answer is A, to protect the lender in case of borrower default. PMI protects the lender against potential losses if the borrower defaults on the loan, especially when the down payment is less than 20%. Federal Housing Administration, FHA Loan.S. Purpose of Federal Housing Administration, FHA loan, and HUD involvement. John is a first-time homebuyer looking for a mortgage with a low down payment. Which type of loan should he consider, and how is the Department of Housing and Urban Development involved? Is it A, Federal Housing Administration loan insured by HUD, B, conventional loan backed by HUD, C, U.S. Department of Veterans Affairs VA loan with HUD involvement, or D, U.S. Department of Agriculture USDA loan insured by HUD? The answer is A, Federal Housing Administration FHA loan insured by HUD. John should consider an FHA loan, which is insured by HUD, to provide more accessible mortgage options with lower down payments. Which of the following best defines the purpose of FHA loans? Is it A, to offer high-interest mortgages, B, to provide loans for luxury homes, C, to make homeownership more accessible, or D, to fund commercial real estate projects? The answer is C, to make homeownership more accessible. FHA loans are designed to make homeownership more accessible by providing insurance to lenders, reducing the risk of lending to borrowers with lower credit scores or down payments. Down payment and credit score requirements. John is considering an FHA loan for his new home purchase. He has a credit score of 580. What is the minimum down payment John should expect to make? Is it A, 10%, B, 3.5%, C, 5%, or D, 20%? The answer is B, 3.5%. With a credit score of 580, John qualifies for a 3.5% minimum down payment under FHA guidelines. Which of the following best describes the FHA's minimum credit score requirement for a 3.5% down payment? Is it A, 620, B, 500, C, 580, or D, 640? The answer is C, 580. The FHA requires a minimum credit score of 580 to qualify for the 3.5% down payment option. Mortgage insurance premium. John is considering an FHA loan and wants to understand the upfront mortgage insurance premium. What percentage of the loan amount is typically charged as UFMIP? Is it A, 1%, B, 1.75%, C, 2%, or D, 0.85%? The answer is B, 1.75%. The upfront mortgage insurance premium for FHA loans is typically 1.75% of the loan amount, regardless of the borrower's credit score or down payment. Which of the following best describes the annual mortgage insurance premium for FHA loans? Is it A, a recurring fee based on loan amount and LTV paid monthly? B, a one-time fee paid at closing? C, a fee based solely on borrower credit score? Or D, a fee that decreases annually as the loan balance decreases? The answer is A, a recurring fee based on loan amount and LTV paid monthly. The annual MIP is a recurring fee based on the loan amount and loan-to-value ratio paid monthly as part of the mortgage payment. Federal Housing Administration, FHA loan, limits in 203 program. John is purchasing a home with an FHA loan under the 203 program. He wants to know what the maximum loan limit is for his area. Which factor primarily determines the FHA loan limit? Is it A, the borrower's credit score, B, the national average home price, C, the median home prices in the area, or D, the borrower's income level? The answer is C, the median home prices in the area. FHA loan limits are primarily determined by the median home prices in the area, ensuring that the limits reflect local housing market conditions. What is the primary purpose of the FHA 203 program? Is it A, to provide low down payment options for homebuyers, B, to refinance existing FHA loans, C, to fund home renovations, or D, to offer loans for commercial properties? The answer is A, to provide low down payment options for homebuyers. The FHA 203 program is designed to help individuals purchase homes with a low down payment, making homeownership more accessible. U.S. Department of Veterans Affairs, VA loans. VA eligibility and entitlement. John, a veteran, is applying for a VA loan for the first time. What is the first step he must take to establish his eligibility? Is it A, submit a loan application to a lender, B, obtain a certificate of eligibility, C, complete a homebuyer education course, or D, provide proof of income? The answer is B, obtain a certificate of eligibility. To establish eligibility for a VA loan, a veteran must first obtain a certificate of eligibility from the VA. This document verifies eligibility for the loan benefits. What is the definition of VA loan entitlement? Is it A, the amount the VA guarantees to a lender in case of borrower default. B, the interest rate offered by the VA on a loan. C, the total loan amount a veteran can borrow. Or D, the duration for which a VA loan is valid. The answer is A, the amount the VA guarantees to a lender in case of borrower default. VA loan entitlement is the amount the VA guarantees to a lender in case of borrower default. It determines the maximum loan amount a veteran can borrow without a down payment. VA funding fee and exemptions. John, a veteran, is applying for a VA loan. He has a service-connected disability. What is John's VA funding fee exemption status? Is it A, exempt from the VA funding fee? B, required to pay the full VA funding fee? C, eligible for a reduced VA funding fee? Or D, eligible for a refund after paying the fee? The answer is A, exempt from the VA funding fee. Veterans with service-connected disabilities are exempt from paying the VA funding fee as per VA guidelines. What is the primary purpose of the VA funding fee in the context of VA loans? Is it A, to increase the interest rate for veterans? B, to reduce the cost of the loan program for taxpayers? C, to provide additional benefits to the lender? Or D, to offer veterans a discount on closing costs? The answer is B, to reduce the cost of the loan program for taxpayers. The VA funding fee helps offset the costs of the VA loan program for taxpayers, ensuring its sustainability. Loan limits and residual income guidelines. John is applying for a VA loan. His lender informs him that the loan limit in his area is $600,000. What does this limit mean for John's borrowing capacity? Is it A, John cannot borrow more than $600,000? B, John must provide a 20% down payment for loans above $600,000. C, the VA will guarantee a portion of the loan up to $600,000. Or D, John's interest rate will be higher for loans above $600,000. The answer is C, the VA will guarantee a portion of the loan up to $600,000. VA loan limits indicate the maximum amount the VA will guarantee. It doesn't cap the loan amount, but affects the down payment needed for amounts above the limit. Which of the following best defines residual income in the context of VA loans? Is it A, net income remaining after taxes and obligations? B, total income before any deductions? C, the loan amount minus the down payment? Or D, the interest rate applied to a VA loan? The answer is A, net income remaining after taxes and obligations. Residual income is the amount of net income remaining after deducting taxes, housing expenses, and other debts. It ensures borrowers have enough funds for living expenses. No down payment feature. John is a veteran looking to purchase his first home using a VA loan. What is a key feature of the VA loan that could benefit John in terms of upfront costs? Is it A, reduced interest rates? B, no down payment required? C, no closing costs? Or D, lower monthly payments? The answer is B, no down payment required. VA loans offer a no down payment feature, allowing eligible veterans like John to purchase a home without needing a large upfront payment compared to conventional loans. Which of the following best defines the no down payment feature of a VA loan? Is it A, allows veterans to finance 100% of the home's purchase price? B, reduces the loan's interest rate? C, waives the funding fee? Or D, provides a grant for home improvements? The answer is A, allows veterans to finance 100% of the home's purchase price. The no down payment feature allows eligible veterans to finance 100% of the home purchase price, eliminating the need for an upfront cash payment. USDA and other government-backed loans. USDA loan eligibility, income and property. Sarah is considering applying for a USDA loan. her household income is $48,000 and the area median income is $50,000. Which rule determines her eligibility based on income? Is it A, her income must be exactly the area median income? B, her income must be above the area median income? C, her income must be at or below 115% of the area median income? Or D, her income must be below 80% of the area median income? The answer is C. Her income must be at or below 115% of the area median income. USDA loans require the applicant's household income to be at or below 115% of the area median income. Since Sarah's income is below the median, she meets this requirement. What is the primary purpose of the USDA loan program? Is it A, to provide affordable housing in rural areas? B, to offer loans for urban development projects? C, to finance agricultural businesses? Or D, to support high-income homebuyers? The answer is A, to provide affordable housing in rural areas. The USDA loan program aims to assist low to moderate income households in obtaining affordable housing in eligible rural areas.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Guarantee and direct loan programs. John is considering applying for a USDA loan to purchase a rural property. Which of the following is a requirement he must meet to be eligible for a USDA direct loan? Is it A, have a credit score above 700? B, own another property? C, have a low or very low income? Or D, reside in an urban area? The answer is C, have a low or very low income. To qualify for a USDA direct loan, the applicant must have a low or very low income as determined by the USDA guidelines. This ensures the program assists those who need it most. Which of the following best describes a USDA guaranteed loan? Is it A, a loan directly provided by the USDA to low-income individuals? B, a loan that requires no credit check for approval? C, a loan only available to farmers and agricultural workers? Or D, a loan backed by the USDA, provided through approved lenders? The answer is D, a loan backed by the USDA, provided through approved lenders. A USDA guaranteed loan is a government-backed mortgage product that assists approved lenders in providing loans to eligible rural homebuyers, ensuring access to affordable housing. Benefits and restrictions of USDA loans. John is considering applying for a USDA loan to purchase a home in a rural area. Which of the following benefits is he likely to enjoy if he qualifies for a USDA loan? Is it A, lower interest rates than conventional loans? B, no income verification required? C, zero down payment requirement? Or D, available for any property type? The answer is C, zero down payment requirement. USDA loans offer zero down payment options, making them attractive for eligible buyers in rural areas who may not have significant savings. What is the primary restriction placed on properties eligible for USDA loans? Is it A, properties must be newly constructed? B, properties must be under 2,000 square feet? C, properties must be multifamily units? Or D, properties must be located in designated rural areas? The answer is D, properties must be located in designated rural areas. USDA loans are restricted to properties located in designated rural areas to promote rural development and homeownership. Loan product structures. Fixed-rate mortgages. John is considering a 30-year fixed-rate mortgage for his new home. What is a key advantage of choosing a fixed-rate mortgage over an adjustable-rate mortgage? Is it A, lower initial interest rates? B, stable monthly payments? C, shorter loan term options? Or D, no prepayment penalties? The answer is B, stable monthly payments. A fixed-rate mortgage provides stability in monthly payments, which helps in financial planning and avoids surprises from interest rate fluctuations. Which statement best defines a fixed-rate mortgage? Is it A, a mortgage with a constant interest rate over the life of the loan? B, a mortgage with varying interest rates based on market conditions? C, a mortgage where the interest rate is fixed for an initial period and then adjusts? Or D, a mortgage with a fixed payment period followed by a balloon payment? The answer is A, a mortgage with a constant interest rate over the life of the loan. A fixed-rate mortgage features a constant interest rate, ensuring that principal and interest payments remain unchanged throughout the loan term. Adjustable-rate mortgages. John is considering an adjustable-rate mortgage with an initial fixed-rate period of 5 years, after which the rate adjusts annually. Which aspect of this ARM should he be most aware of after the initial period? Is it A, the initial interest rate, B, the frequency of rate adjustments, C, the loan's amortization schedule, or D, the loan's prepayment penalties? The answer is B, the frequency of rate adjustments. After the initial fixed period, the interest rate can change annually, potentially increasing his monthly payments significantly depending on market conditions. What is the primary feature that distinguishes an adjustable-rate mortgage from a fixed-rate mortgage? Is it A, the initial loan term, B, the type of collateral required, C, the variability of the interest rate, or D, the down payment requirements? The answer is C, the variability of the interest rate. ARMs have interest rates that change periodically based on an index, unlike fixed-rate mortgages, where the rate remains constant. Balloon loans and hybrid loans. A borrower is considering a balloon loan with a term of 5 years. What happens at the end of the term if they have not refinanced the loan? Is it A, the loan is automatically renewed for another term, B, the interest rate is adjusted to the current market rate, C, the borrower must pay off the remaining balance in full, or D, the loan converts to a fixed-rate mortgage? The answer is C, the borrower must pay off the remaining balance in full. At the end of a balloon loan term, the borrower must pay the remaining balance in full, as the loan is not fully amortized over its term. Which statement best defines a hybrid loan? Is it A, a loan that starts with a fixed rate and transitions to an adjustable rate, B, a loan that adjusts interest rates every month, C, a loan that remains fixed for its entire duration, or D, a loan with a balloon payment at the end of the term? The answer is A, a loan that starts with a fixed rate and transitions to an adjustable rate. A hybrid loan combines features of both fixed-rate and adjustable-rate mortgages, typically starting with a fixed-rate period followed by an adjustable-rate phase. Interest-only loans and negative amortization. John is considering an interest-only loan where he will only pay interest for the first 5 years. What will happen to his loan balance after this period? Is it A, the loan balance will remain the same, B, the loan balance will increase, C, the loan balance will decrease, or D, the loan will be fully paid off? The answer is A, the loan balance will remain the same. After the interest-only period, John will start paying both principal and interest, increasing his monthly payments as the loan balance remains unchanged during the interest-only term. What is the primary characteristic of a negative amortization loan? Is it A, payments are fixed throughout the loan term, B, principal balance decreases over time, C, only interest is paid during the initial period, or D, unpaid interest is added to the principal balance? The answer is D, unpaid interest is added to the principal balance. In negative amortization loans, monthly payments are less than the interest accrued, causing the unpaid interest to be added to the principal balance.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Non-traditional and specialty products. Reverse mortgages. Scenario: Mary, a 72-year-old homeowner, wants to understand the benefits of a reverse mortgage. What is a key advantage she should consider? Is it A, it requires monthly payments from the borrower? B, it provides access to home equity without monthly payments? C, it decreases the home's value over time? Or D, it requires the borrower to be under 62 years old? The answer is B. It provides access to home equity without monthly payments. A reverse mortgage allows homeowners like Mary to access their home's equity without monthly payments, providing financial flexibility in retirement. What is a home equity conversion mortgage? Is it A, a traditional mortgage for purchasing a home? B, an unsecured loan for home renovations? C, a government-insured reverse mortgage program? Or D, a short-term loan for paying off existing debts? The answer is C, a government-insured reverse mortgage program. A HECM is a government-insured reverse mortgage program that allows seniors to convert home equity into cash, providing financial support during retirement. Subprime and Alt-A loans. John is considering a subprime loan due to his low credit score. Which of the following is a characteristic he should expect from a subprime loan? Is it A, lower interest rates? B, higher interest rates? C, no down payment required? Or D, fixed monthly payments? The answer is B, higher interest rates. Subprime loans typically have higher interest rates due to the increased risk associated with lending to individuals with lower credit scores. Which of the following best defines an Alt-A loan? Is it A, a loan for borrowers with good credit but limited documentation? B, a loan exclusively for first-time homebuyers? C, a loan with adjustable interest rates only? Or D, a government-backed loan for low-income families? The answer is A, a loan for borrowers with good credit but limited documentation. Alt-A loans are for borrowers who fall between prime and subprime, often due to lack of documentation or minor credit issues. Loan suitability and risk factors. Assessing borrower needs and product fit. A borrower is seeking a loan to consolidate high-interest credit card debt. Which loan product should a loan officer recommend to best fit the borrower's needs? Is it A, adjustable rate mortgage? B, home equity line of credit? C, personal loan? Or D, reverse mortgage? The answer is C, personal loan. A personal loan is typically unsecured and can be used to consolidate high-interest debt, offering a lower interest rate than credit cards. What is the primary purpose of a debt-to-income ratio in assessing borrower needs? Is it A, to determine the borrower's credit score? B, to assess the borrower's ability to repay? C, to establish the loan's interest rate? Or D, to calculate the loan's term length? The answer is B, to assess the borrower's ability to repay. The DTI ratio evaluates a borrower's ability to manage monthly payments and repay debts, crucial for determining loan suitability. Loan risk based on structure and borrower profile. Scenario: Emily is considering a loan with a balloon payment structure. What is a significant risk factor associated with this type of loan? Is it A, higher interest rates throughout the term? B, fixed monthly payments? C, large final payment? Or D, no risk of default? The answer is C, large final payment. Balloon payment loans carry the risk that the borrower may not be able to make the large final payment, leading to potential default. What is the primary risk of a loan with a variable interest rate for a borrower? Is it A, fixed monthly payments, B, unpredictable monthly payments, C, lower initial interest rate, or D, no risk of payment changes? The answer is B, unpredictable monthly payments. Variable interest rates can lead to unpredictable monthly payments, which can increase significantly if rates rise.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy AI for complimentary study sessions with Birdsy, your AI-powered study partner.